When you walk into a bank and deposit your paycheck, you think you own that money. But legally you don't. The moment you hand over your cash, you've just made an unsecured loan to the bank. Your deposit becomes their asset and you become their creditor. In 2013, Cyprus proved how dangerous this really is. The Bank of Cyprus took every deposit over €100,000 and converted it into worthless bank shares overnight. Families lost their life savings in a single day, their cash replaced with stock certificates worth nothing. And here's what should terrify you. The United States passed the exact same legal framework in 2010. It's called the Dodd-Frank Act, Title II, and it gives banks the power to seize your deposits and convert them into bank equity during any crisis they declare systemic. Your savings account isn't your money anymore, it's their emergency fund. If this makes you realize your money isn't as safe as you thought, subscribe because the mechanisms they've built to take it are already in place and operational. The fundamental misconception that governs modern banking relationships centers on a single devastating legal reality that most depositors never comprehend until it becomes catastrophically relevant to their financial survival. When an individual approaches a bank teller and deposits their paycheck, retirement savings, or business proceeds, they operate under the assumption that this transaction represents the storage of their personal property in a secure institutional vault. This assumption represents one of the most dangerous financial illusions of contemporary economic life, because the legal framework governing banking deposits operates on entirely different principles than public understanding suggests. Under established banking law throughout the United States and most developed nations, the act of depositing money into a bank account does not create a bailment relationship where the bank serves as a custodian of the depositor's property. Instead, this transaction legally constitutes an unsecured loan from the depositor to the banking institution. The moment cash crosses the teller window or electronic transfer completes, legal ownership of that money transfers completely to the bank, which then assumes a liability to repay the depositor upon demand. This liability appears on the bank's balance sheet as a debt obligation, while the deposited funds become part of the bank's working capital, available for lending, investment, and operational expenses. The depositor's checking or savings account balance represents nothing more than an accounting entry reflecting the bank's promise to pay, not a segregated pool of the depositor's original money sitting in some metaphorical vault. This legal structure means that depositors hold the same legal standing as any other unsecured creditor of the banking institution, ranking alongside bondholders, trade creditors, and other parties to whom the bank owes money. The implications of this creditor status remained largely theoretical until legislative changes following the 2008 financial crisis transformed these legal technicalities into actionable mechanisms for wealth confiscation. The Dodd-Frank Wall Street Reform and Consumer Protection Act, signed into law in 2010, fundamentally altered the landscape of banking resolution procedures through its Title II provisions, officially designated as the Orderly Liquidation Authority. This legislative framework emerged as Congress's response to the public outrage surrounding taxpayer-funded bailouts of major financial institutions during the previous crisis. But the cure proved potentially more dangerous than the disease for ordinary depositors. Title II grants extraordinary powers to federal regulators, specifically the Federal Deposit Insurance Corporation and the Treasury Department, to seize control of large financial institutions deemed to pose systemic risks to the broader economy. Under this authority, regulators can place failing banks into receivership and restructure their obligations according to a predetermined hierarchy that treats different classes of creditors with varying degrees of protection. The legislation explicitly authorizes what financial experts term bail in procedures, where the losses of a failing financial institution are absorbed not by taxpayers through government bailouts, but by the institution's creditors and shareholders through forced conversion of debt into equity or outright loss absorption. The critical revelation lies in understanding how this mechanism treats bank depositors within the creditor hierarchy. While insured deposits below Federal Deposit Insurance Corporation limits theoretically receive protection, uninsured deposits and depositors holding amounts exceeding insurance thresholds find themselves classified as unsecured creditors subject to bail-in procedures. This classification means that regulatory authorities possess the legal power to convert deposits above insurance limits into bank equity, effectively transforming depositors' liquid savings into shares of a failing institution, or to impose haircuts that eliminate portions of deposit balances entirely. The transformation from depositor to involuntary shareholder represents a modern form of wealth confiscation that operates within perfectly legal parameters, converting private savings into bank capital designed to absorb institutional losses while maintaining the appearance of systematic financial stability. The operational mechanics of bail in procedures under Title II of the Dodd-Frank Act reveal a sophisticated wealth extraction system disguised as prudential banking regulation, operating through a carefully constructed legal framework that prioritizes institutional stability over individual depositor protection. When federal regulators determine that a large financial institution has reached a state of default or imminent danger of default, while simultaneously posing systemic risks to the broader financial system, they possess the authority to invoke the Orderly Liquidation Authority and place the troubled institution under Federal Deposit Insurance Corporation receivership. This determination requires no court approval, no advance warning to depositors, and no opportunity for affected parties to contest the decision, representing a form of financial martial law that can be implemented over a weekend. The receivership process operates according to a predetermined claims priority ladder that determines which creditors receive full repayment, which face partial losses, and which absorb complete write-offs during the resolution process. This hierarchy places secured creditors, those holding claims backed by specific collateral, at the top of the repayment structure, followed by administrative expenses of the receivership itself. Then insured deposits up to Federal Deposit Insurance Corporation limits, and finally unsecured creditors, including uninsured depositors, bondholders, and trade creditors. The critical manipulation occurs in how this system classifies and treats different types of banking obligations, particularly the distinction between secured and unsecured claims. Under the Title II framework, uninsured deposits automatically fall into the unsecured creditor category, meaning that any depositor holding amounts exceeding current insurance limits of $250,000 per account finds their excess funds subject to the same treatment as corporate bondholders or other institutional creditors. This classification enables regulators to impose haircuts, converting portions of these deposits into equity shares of the reorganized institution, or to eliminate them entirely as part of the loss absorption necessary to recapitalize the failed bank. The equity conversion process typically occurs at deeply discounted valuations that reflect the distressed nature of the institution, effectively ensuring that converted deposits purchase shares worth far less than their original cash value. The legal justification for this mechanism centers on shifting the burden of banking failures away from taxpayers and onto private creditors, who theoretically chose to accept risk in exchange for the benefits of banking relationships. However, this rationale deliberately obscures the reality that ordinary depositors never consciously accepted creditor status or understood their vulnerability to loss absorption. The system treats a family's life savings, held in excess of insurance limits, identically to sophisticated institutional investors who purchased bank bonds with full knowledge of subordination risks and potential losses. The receivership authority extends beyond simple deposit conversion to encompass comprehensive balance sheet restructuring that can freeze access to funds indefinitely while resolution procedures unfold. During this process, depositors lose all liquidity access to their converted or contested funds, creating immediate financial hardship for individuals and businesses dependent on those resources for ongoing operations. The Federal Deposit Insurance Corporation, acting as receiver, possesses broad discretionary powers to determine the pace of resolution, the terms of equity conversion, and the ultimate recovery rates for affected creditors. The most insidious aspect of the bail-in mechanism lies in its capacity to operate retroactively on existing deposits, meaning that funds deposited years before any crisis can be subject to conversion or loss, without the depositor having any opportunity to withdraw their money once regulators initiate proceedings. This retroactive application transforms every large deposit into a potential involuntary investment in bank equity, creating a hidden tax on savers that can be activated whenever regulatory authorities deem it necessary for systemic stability. The theoretical frameworks of deposit confiscation through bail in mechanisms transitioned from academic speculation to devastating reality during the Cyprus banking crisis of 2013, providing a real-world demonstration of how sophisticated financial engineering can instantly transform private savings into worthless equity while maintaining the veneer of legal legitimacy. The Republic of Cyprus, a European Union member state with a banking sector grossly disproportionate to its domestic economy, became the testing ground for bail in procedures that would later influence regulatory frameworks across developed nations, including the United States. The crisis originated from Cyprus banks' massive exposure to Greek sovereign debt and real estate speculation, creating systemic vulnerabilities that required immediate intervention to prevent complete financial collapse. The Bank of Cyprus, the nation's largest financial institution, served as the primary vehicle for implementing the first large-scale bail-in of retail depositors in modern banking history. As the crisis intensified throughout March 2013, Cypriot authorities faced an impossible choice between accepting a European Union bailout package that required significant depositor losses or allowing the banking system to collapse entirely. The eventual resolution demonstrated the ruthless efficiency of bail in procedures when applied to ordinary savers who had no sophisticated understanding of their legal vulnerability as unsecured creditors. On April 28, 2013, the Bank of Cyprus executed the most comprehensive deposit-to-equity conversion ever attempted against retail depositors, fundamentally altering the relationship between banks and their customers throughout the European Union. All deposit balances exceeding €100,000, including accrued interest, faced immediate conversion into Class A shares of the restructured bank at nominal value, effectively confiscating the real purchasing power of these deposits while providing worthless paper certificates in return. The conversion rate heavily favoured the bank's recapitalisation needs over depositor interests, with every €100,000 in deposits above the threshold, converting into approximately €25,000 worth of bank equity based on the institution's distressed valuation. The mechanical implementation of the bail-in revealed the true powerlessness of depositors when regulatory authorities decide to activate these procedures. Depositors received no advance warning, no opportunity to withdraw funds, and no legal recourse to challenge the conversion. Bank branches remained closed for nearly 2 weeks while authorities completed the balance sheet restructuring, during which time depositors could neither access their funds nor prevent their conversion into equity. When banks finally reopened, capital controls limited daily withdrawals to €300 per person, transforming Cyprus into a cash-based economy overnight and demonstrating how quickly modern electronic banking can be weaponized against ordinary citizens. The broader economic chaos that followed the deposit confiscation illustrated the devastating secondary effects of bail in procedures on social stability and economic confidence. Small businesses lost operational capital, retirees discovered their life savings converted into shares of a failing institution, and families found themselves unable to access funds for basic necessities. The newly issued bank shares proved largely worthless, trading at fractions of the original deposit values when secondary markets eventually developed. Many depositors simply abandoned their shares rather than attempting to recover any value from their converted deposits. The Cyprus precedent established critical legal and operational precedents that banking regulators worldwide studied carefully, recognizing that deposit confiscation through bail in procedures could be implemented rapidly and effectively, even against retail depositors with minimal sophisticated financial knowledge. The success of the Cyprus operation in preventing complete banking system collapse while shifting losses from taxpayers to depositors provided a template that influenced subsequent regulatory frameworks, including the enhanced resolution authorities embedded within United States banking law. The embrace of bail in mechanisms by financial regulators worldwide reflects a carefully orchestrated shift in crisis management philosophy that serves banking elite interests while creating devastating vulnerabilities for ordinary depositors who remain largely unaware of their new role as involuntary capital providers. The official justification for bail in procedures centers on eliminating moral hazard and ending the too big to fail paradigm that characterized the 2008 financial crisis, when massive taxpayer-funded bailouts rescued failing institutions while their management teams and shareholders faced minimal consequences for reckless behavior. Regulators argue that by forcing shareholders and unsecured creditors, including large depositors, to absorb losses during banking failures, the bail-in framework creates proper incentives for prudent risk management and eliminates the expectation that government resources will always be available to rescue failing financial institutions. This publicly stated rationale conceals the far more sinister reality that bail in procedures transform the entire depositor base into a hidden reservoir of emergency bank capital that can be accessed whenever institutional survival requires immediate recapitalization. Banking executives and their regulatory allies recognize that large deposits represent the most accessible and legally vulnerable source of crisis funding, requiring no legislative approval, no public debate, and no taxpayer consent to activate. The mechanism effectively converts every substantial savings account into a contingent capital instrument that automatically triggers during periods of institutional stress, providing banks with an involuntary insurance policy funded entirely by their own customers. The wealth extraction implications of this system become apparent when examining how bail-in procedures systematically transfer value from productive savers to failing financial institutions and their remaining stakeholders. Families who accumulate substantial life savings through decades of prudent financial behavior, small business owners maintaining operational capital, and retirees preserving purchasing power for their remaining years find their wealth suddenly conscripted to absorb losses generated by banking speculation and mismanagement they neither participated in nor benefited from. The conversion of deposits into equity at distressed valuations ensures that these involuntary investors receive shares worth far less than their original cash contributions, representing a direct transfer of wealth from depositors to the restructured institution. Banking industry insiders and their regulatory allies maintain enormous leverage through this framework because they control both the timing of crisis declarations and the terms of resolution procedures. Management teams facing institutional failure can strategically invoke bail in procedures to preserve their positions and minimize personal losses, while shifting the burden to depositors who possess no voice in the decision-making process. The discretionary nature of default determinations means that regulatory authorities can selectively apply bail in procedures based on political considerations, institutional relationships, or systemic convenience rather than objective financial criteria. The systematic nature of this wealth extraction becomes particularly insidious when considering how bail-in frameworks incentivize banking institutions to pursue increasingly aggressive risk-taking strategies. Banks operating under bail-in regimes understand that their depositor base provides a readily available source of emergency capital that can be accessed without the traditional constraints associated with equity fundraising or debt issuance. This implicit subsidization of risk-taking behavior creates a perverse incentive structure where banks can pursue speculative activities with the knowledge that losses will ultimately be absorbed by depositors rather than shareholders or management. The regulatory preference for bail in procedures also reflects the convenience of avoiding difficult political battles associated with taxpayer-funded bailouts, while maintaining the essential function of preserving banking system stability. This approach allows regulators to appear responsive to public opposition to bailouts, while actually expanding their power to restructure failing institutions using private wealth rather than public resources, creating the illusion of market discipline while actually socializing losses among a broader base of involuntary participants. The pervasive public confidence in Federal Deposit Insurance Corporation protection represents one of the most dangerous financial misconceptions of contemporary banking, creating a false sense of security that obscures the genuine vulnerabilities facing depositors during institutional failures resolved through bail-in procedures. The standard narrative promoted by banking institutions and regulatory authorities emphasizes deposit insurance as a comprehensive safety net that protects ordinary savers from banking failures, fostering the widespread belief that government guarantees eliminate the risks inherent in modern banking relationships. This messaging deliberately obscures the severe limitations of deposit insurance coverage and the mechanisms through which insured deposits themselves can become compromised during systemic banking crises. Federal Deposit Insurance Corporation coverage extends only to deposits up to $250,000 per depositor per insured institution, leaving any excess amounts completely unprotected and subject to the full range of bail in procedures available to regulatory authorities. This threshold limitation means that substantial savers, including retirees with accumulated life savings, small business owners maintaining operational capital, and families who have saved responsibly for decades, find significant portions of their wealth exposed to confiscation through deposit-to-equity conversions or outright loss absorption. The mathematical reality demonstrates that even modest accumulations of wealth quickly exceed insurance thresholds, particularly when considering joint accounts, business relationships, and multiple family members using the same institution. The operational mechanics of Federal Deposit Insurance Corporation receivership reveal how deposit insurance can be manipulated or suspended entirely when regulatory authorities determine that broader systemic concerns override individual depositor protection. When the Federal Deposit Insurance Corporation assumes control of a failed institution under Title II authority, it operates as receiver with extraordinary discretionary powers that include the ability to establish bridge banks, transfer assets selectively, and restructure liabilities according to resolution priorities that may not align with traditional deposit insurance commitments. During this process, the Federal Deposit Insurance Corporation can segregate healthy assets and secured obligations into bridge institutions while leaving unsecured creditors, including uninsured depositors, to absorb losses in the residual entity. The bridge bank mechanism enables regulatory authorities to preserve the valuable components of failed institutions while isolating and eliminating the problematic liabilities that contributed to institutional failure. This selective preservation process ensures that preferred creditors and systemically important obligations receive full protection while ordinary depositors face partial or complete losses on uninsured amounts. The Federal Deposit Insurance Corporation's role as receiver grants it the authority to determine which deposits transfer to bridge banks and which remain subject to loss absorption, creating opportunities for discriminatory treatment based on relationship banking, political considerations, or systemic convenience rather than equitable protection principles. During genuine systemic banking crises, when multiple large institutions face simultaneous failure, the Federal Deposit Insurance Corporation's insurance funds become mathematically insufficient to honor traditional coverage commitments, forcing regulators to choose between depleting public resources and invoking bail in procedures broadly across the banking system. Historical analysis of the Federal Deposit Insurance Corporation's financial capacity demonstrates that simultaneous failures of major banking institutions would exhaust insurance reserves within days, leaving regulators with no alternative except widespread application of Title II resolution procedures that prioritize systemic stability over individual depositor protection. The public messaging surrounding deposit insurance deliberately cultivates complacency among ordinary savers by emphasizing the government guarantee while minimizing discussion of coverage limitations, systemic crisis scenarios, and the regulatory discretion that can override traditional insurance commitments. This communication strategy serves the dual purpose of maintaining depositor confidence necessary for banking system stability, while preserving regulatory flexibility to implement wealth confiscation procedures when institutional survival requires immediate access to depositor funds, regardless of insurance promises. The convergence of structural economic vulnerabilities throughout 2025 and beyond creates an increasingly volatile environment where bail-in mechanisms become not merely theoretical regulatory tools, but practical necessities for preserving banking system stability at the expense of ordinary depositors. The global debt architecture has reached unprecedented levels that fundamentally compromise the stability of financial institutions and their ability to absorb losses through traditional equity buffers. Sovereign debt across developed nations has exploded beyond sustainable thresholds, with the United States federal debt exceeding $38 trillion, European Union member states carrying debt to gross domestic product ratios approaching or exceeding 100%, and emerging market economies struggling under dollar-denominated obligations that become increasingly burdensome as currency devaluations accelerate. Private sector debt accumulation has reached equally dangerous proportions, with corporate borrowers leveraged to levels that exceed those preceding the 2008 crisis, while household debt service ratios strain family budgets across income demographics. Commercial real estate markets face systematic repricing as remote work patterns permanently alter demand structures, creating massive unrealized losses on banking balance sheets that have yet to be properly acknowledged through mark-to-market accounting practices. The combination of over-leveraged borrowers and deteriorating collateral values creates the precise conditions that historically trigger cascading banking failures requiring immediate regulatory intervention. Banking institutions themselves operate with balance sheets stretched far beyond prudent risk management parameters, maintaining loan-to-deposit ratios that leave minimal buffers for absorbing credit losses while pursuing increasingly aggressive lending standards to maintain profitability in compressed interest rate environments. The rapid interest rate increases implemented by central banks throughout 2022 and 2023 created immediate pressure on banking institutions holding large portfolios of long-duration assets purchased during the zero interest rate period, generating unrealized losses that exceed the equity capital of numerous regional and community banks across the United States. Banking executives and regulatory authorities fully understand that traditional taxpayer-funded bailouts have become politically impossible, following the public outrage that accompanied the 2008 crisis response, creating powerful incentives to implement bail in procedures that shift losses to private depositors rather than public resources. The legal frameworks established through Dodd-Frank and similar international regulations provide ready-made mechanisms for wealth confiscation that require no legislative approval, no public debate, and no political accountability, making them the preferred solution for banking crises that demand immediate capitalization. The systematic incentive structure now favors bail in implementation, because it allows banking management teams to preserve their positions and compensation, while regulatory authorities demonstrate responsiveness to anti-bailout sentiment without actually imposing meaningful consequences on the banking industry itself. This alignment of interests between banking executives seeking survival and regulators seeking political cover creates a powerful coalition supporting the use of depositor funds to absorb institutional losses whenever traditional capital raising proves insufficient or too time-consuming during crisis conditions. The mathematical reality of modern banking demonstrates that institutions cannot survive major credit losses or liquidity crises without accessing depositor funds through conversion mechanisms, because traditional equity buffers represent only small percentages of total liabilities, while uninsured deposits often constitute 20 to 40% of institutional funding. Depositors maintaining savings above Federal Deposit Insurance Corporation limits essentially provide involuntary capital insurance to their banking institutions, creating vulnerabilities that become activated automatically when regulatory authorities determine that institutional survival requires immediate recapitalization, regardless of depositor consent or prior understanding of these risks. The fundamental transformation of the banking relationship from custodial storage to unsecured creditor status represents the most significant wealth confiscation mechanism embedded within contemporary financial law, operating through legal structures that treat ordinary depositors as involuntary lenders, whose claims can be extinguished or converted whenever institutional survival demands immediate capital infusion. The legal reality governing modern banking deposits contradicts every intuitive understanding that ordinary savers possess about their relationship with financial institutions, because the act of depositing money creates no property rights, no segregated ownership, and no guaranteed claim to specific funds held by the banking institution. Instead, depositors acquire only contractual rights to repayment that rank alongside other unsecured obligations and can be subordinated, converted, or eliminated entirely when regulatory authorities determine that institutional preservation requires depositor sacrifice. This creditor relationship enables banking institutions and their regulatory allies to access depositor wealth through legally sanctioned mechanisms that require no advance warning, no depositor consent, and no compensation for the real economic losses imposed on ordinary savers. The Title II framework, embedded within Dodd-Frank legislation, provides comprehensive legal authority for deposit conversion that operates independently of traditional bankruptcy protections, constitutional property rights, or democratic oversight processes. When regulatory authorities invoke these powers, depositors lose all legal standing to challenge the conversion of their savings into bank equity, or the imposition of haircuts that eliminate portions of their accumulated wealth. The Cyprus precedent established during 2013 demonstrates the operational effectiveness of these wealth confiscation procedures when applied against retail depositors who possessed no sophisticated understanding of their legal vulnerability as unsecured creditors. The systematic conversion of deposits exceeding €100,000 into worthless bank shares occurred without meaningful resistance, legal challenge, or political consequence, proving that deposit confiscation can be implemented rapidly and completely, even against ordinary families and small businesses. The success of the Cyprus operation provided a template that regulatory authorities worldwide have studied and incorporated into their own crisis resolution frameworks, ensuring that similar procedures can be activated whenever banking stability requires immediate access to depositor funds. The mathematical inevitability of future bail in implementation becomes apparent when examining the structural vulnerabilities that characterize contemporary banking systems operating under unsustainable debt loads, compressed profit margins, and regulatory frameworks that explicitly prioritize institutional survival over depositor protection. As economic conditions deteriorate and banking institutions face cascading losses from over-leveraged borrowers, deteriorating real estate portfolios, and interest rate pressures, regulatory authorities will face immediate pressure to preserve banking system functionality through whatever means provide the fastest and most comprehensive recapitalization. The millions of ordinary savers who maintain substantial deposits in traditional banking institutions remain largely unaware that their accumulated wealth serves as contingent capital for institutional failures, available for conversion or confiscation whenever regulatory authorities determine that depositor sacrifice serves broader systemic purposes. The legal mechanisms for wealth extraction already exist in fully operational form, requiring only regulatory activation to transform liquid savings into illiquid equity holdings in failing institutions or to eliminate depositor wealth entirely through loss absorption procedures. The inevitable conclusion reveals that contemporary banking relationships represent sophisticated wealth extraction systems disguised as customer service relationships, where depositor funds provide involuntary insurance against institutional failure, while banking executives and regulatory authorities maintain exclusive control over the timing and terms of wealth confiscation procedures designed to preserve banking system stability at ordinary depositors' expense.